All right, we are back. Let's cover this. So now we're going to talk a little bit about using AI for personal finance advice. According to this CNBC article, they're talking about different studies that have been concluded that say not to use it for personal finance advice. Let's look into why and see if we agree. A new study in the Journal of Financial Planning found that our artificial intelligence programs can provide inconsistent, inaccurate, or biased recommendations. Researchers prompted 7 AI programs with questions about emergency savings, asset allocation, and withdrawals from a retirement portfolio. The findings align with those of other experts who recommend using AI as a starting point for financial questions, but not as a final authority. It's very interesting. Let's see here. I'm looking for information that is, it's suboptimal or biased outputs, raise questions about the consistency and fairness of Gen AI driven recommendations. A large share of Americans are turning to AI. 2 out of 3 Americans who have used Gen AI said they've leveraged it for financial advice. So I do have one issue with this off the bat. AI cannot provide advice. Advice is based on knowing who you're talking to. There's a reason why whenever I'm on stream or I release videos, I never give blanket statements on what people should invest and how they should invest, because I don't know those people. I don't know you. We could talk about why you should or shouldn't do things, but to give actual recommendations, you have to know your client. And it's impossible for AI to do that. The other issue with AI is it just takes information from other sources, puts it all together, and then puts out information depending on the question being asked. So there's no real way to get a specific answer for you. How does it know your risk tolerance? How does it know your time horizon? How does it know essentially how you're going to react when the market does different things? So yeah, it can give high level overviews of financial topics, why it's important to diversify and things like that, but it cannot give you advice because it doesn't know you. All right. So in chat here, found that AI recommends the 80-20 portfolio, and usually it recommends the 500 index to me. Very interesting. So I wonder if that's from internet commentary or what it is, but that is a very interesting thing for to read there. But yeah, it could just be taking information from the internet where a lot of people talk about just buy the 500 index fund and you can own it forever, and that's all you need, but it doesn't talk about the potential downsides of that. So let's see what else this article is saying. When it comes to very, very specific calculations of your own personal situation, that's where you have to be very, very careful. Of course, it can't know everything. The chat says Reddit always recommends the 500 index fund. It has become very popular. Very popular. I mean, it is about 80% of the US stock market in those 500 stocks, which is wild. And then those top 10 is heavily concentrated in those top 10 in the 500 index fund. So let's see here. Aha, here we go. AI also doesn't owe a fiduciary duty to its users. That is very true. And fiduciary standards are very important when it comes to advice. A fiduciary has to do what's in your best interest. I personally am a certified financial planner professional, and to hold that designation, I have to be a fiduciary, which means I always have to put your situation above my own. I always have to put you first. It's one of the reasons I love having the credential. So I can't sell you something because it's going to get me a check or anything like that. Now, I don't have any products or classes to sell you. I'm just using it as an example. But Being a fiduciary means you have to do what's in the best interest of your clients. If someone is, if you're working with somebody and they're not a fiduciary, be careful. And that's definitely a question you should ask somebody you're working with. Are you a fiduciary to me? Let's see here. Generic. We believe that ChatGPT could serve as a starting point. Variance and guidance. Yeah, I mean you're definitely going to get different variations of guidance depending on where you go. Where are they getting their information to tell you what to do? I think essentially, in short, AI can be a great place to get some education. If you're unsure about terms or things to think about, then AI can be a great resource for you to learn. Type in your question, you get an answer. I would still double check that answer, but it's still going to be a good place to start, especially if you don't know anything. You could start to build a foundation and then maybe go to more of an expert or a fiduciary for actual recommendations. But I think the human to human component of financial advice is always going to be important, because I believe there was a study done, this was maybe 5 years ago now, that people were saying they are very comfortable with using AI models to invest their money. And that's probably true. And the study showed that when markets are up, that is true because you're not really thinking about anything. The market's going up, you're watching your portfolio grow, you feel good about what it's doing. But then when the pandemic happened and markets tanked, people wanted to turn to a human being about what they should do, because a human generally needs another human to help feel comfortable with their situation and how they're investing, to understand if they're still on course and if they should stick to their plan. Whereas AI or other computer based models, they're just making changes based on what the market is doing. And a human might not understand the why, even if the computer model is doing what's in the best interest of the client. If the client doesn't understand why those things are happening, then they're likely to make mistakes. And one of the biggest mistakes people make is actually selling out of their portfolios when markets are down. It's one of the only ways to lock in losses. Some of my most sad conversations when I worked for Vanguard were when I would talk to somebody, try to convince them that selling out during a downturn was a bad move. And there were two conversations where I was unable to convince somebody to stick to their plan during that pandemic downturn. And then, the markets recovered pretty quickly after that. But those two people sold because they couldn't deal with the volatility. So they locked in those losses and did not gain the money back when it rose. Now, they maybe invested in the markets again when markets went up, but it's almost impossible to time the market. It's almost impossible to know when the best time to get back in the market. And what happens a lot of the time is people miss out on the growth in the market because they tried to time it, waited for the right time, as they say, and they just essentially missed on a good chunk of portfolio returns. And I have a story like this as well. The 0809 housing crisis, which also tanked the stock market, I believe the Dow was at like 14-ish thousand before that, and then it tanked, and then it took a few years for it to come back. Well, me being a smart young finance guy at the time, I thought, man, we've reached all-time highs. I'm going to go ahead and move to cash so I can be ready for the next crash. And instead, the Dow, that's just the one that sticks out for me, went from like 14 to 17,000 or something like that. I realized, well, there's no driving force to push it back down again. So I reinvested at 17,000. Now, thankfully, I didn't have much money in the markets, and it was a learning lesson early in my financial life that I have no idea what the market's going to do. And that's where I've shifted to my belief today in being somewhat of a forever bull, that, yeah, markets are going to go down at different points in time, But in the long run, I believe markets are going to be significantly higher in the future than where they are today. One of the things I like to tell people is today's all-time high can be next year's buying opportunity, because markets historically have gone up and some people wait for that pullback. So the market goes up 10 to 15%, then they have somewhat of a pullback, which puts them maybe right back to where they were. And now they feel like it's a good time to buy. It's like you could have just been owning this whole time. But anyway, so to AI, use it as an educational resource. I probably wouldn't use it to direct your investments and to take actual advice from it. You can always come here for free and ask questions. I am a fiduciary, and I'm here to help people get better with their money.